Advance decline 1:1, but that's just the first within the first 1 minute that we are looking at things. Okay, now the Nifty has got some momentum going as well. So 50 points, we're at about 24,850 at this point in time. The Nifty heat map, it's bulk of it, most of it up in the green. Very few names are down in the red. About 5-6 names are in the red. Everything else is starting higher. Surabhi.
Market in Friday mood, it seems. It's a fair amount of green on the screen. By the way, the project financier stocks, they are all up and about. PFC, RAC, Irida, Hoodco, gains between 1.5% to 3.5%, depending on which one you are looking at. And that's, as Lata was just explaining to us, the final norms that have come out are less onerous than the draft norms. So it's a big relief and an overhang which has been removed. For the Nifty, what is taking the Nifty up 60 points? Let's find out. Nestle, Trent, there's Tata Motors. A lot of the banks are doing very well. The Bank Nifty is actually much better than the Nifty. The Bank Nifty is up 0.4%. SBI is the one which is pushing it right on top. Axis Bank is having a good morning as well. Let's see what's up with the HDFC Bank. Also minor gains coming in there. ICICI Bank is very quiet, 0.2% up. But banks looking good. Overall financials, Jio Finance also 0.5% higher. Shriram Finance, Bajaj Finserv. So financials are a solid spot. Nestle, remember, is looking at a bonus issue soon. So 1.5% up on that stock. Trent continues its good form from this week. There's a little bit of buying on something like Asian Paints as well. So that's the gainers tally. On the losing side, not too many stocks actually. Hero Moto and Bajaj Auto, which have had a good week otherwise. They're cooling off a little bit. And IndusInd Bank slightly lower as well. But otherwise, 78 points higher, Nigel. I think the bulls will take it with both hands.
Well, that's right. Surabhi, there's Northern Arc. There's a large trade that's taken place, actually. 14% equity that's up on the screen. It'll be interesting to see who exactly were the parties. Leapfrog, that's one that has close to around 16% stake. Augusta Investments, that's another one that has 16% stake. So could be a large holder that's, in fact, pressed the exit button. Large trade taking place explains why the stock is down close to around 7%. What's taking it on the chin? Sun TV, that's lower because of the promoter feud out there. ITD Cementation, that's a stock actually that's doing well. The order win that's come in there. So that's why that stock is up and about in today's trading session. On the Nifty, typically you see this. In the previous day, if you have a low close, yesterday the last tick of the day was actually minus 60 points. The next day you normally see that being made up, and that's precisely what's happened. So that's why we're up close to around 80 points. The fall that we saw in the final 30 minutes of trade yesterday was more to do with the expiry-related factor. What else is doing well? Finiotex Chemicals, that one's come on the radar. That's up close to around 4%, one of the winners on the Nifty. So good up move is what we're seeing on that one. Axis Gates, actually, that's been moving from circuit to circuit. Today as well, it's up close to around 3.5%. So good move is what we're seeing on that particular name. On the downside, Northern Arc, that one deserves special mention. 2 crore shares changing hands, I think. So on Sai Life as well. So 10% equity, that's out of the way. That stock is well down, only around 1% for such a large trade. Prashant.
Oh, no, absolutely. Axis Cades is, was up 5% yesterday, and I think it's starting higher right now as well. So 3.5% higher. We'll talk more about this one as we kind of sort of go along. But you've got a market which I think is looking much better now. The Nifty will come up on your screen, and we'll then talk about more stocks, etc. So 76 points. It's a better Friday as compared to any of the last 4 sessions that we've had. Harish Krishnan is with us, co-CIO, head of equity at Aditya Birla Sun Life Asset Management Company. Harish, good to have you with us here. Thanks very much for your time. I want to just start with at the margin all the all the blocks, etc., which you've been seeing. And the interest is such that at least twice or thrice this week we've seen these offerings upsized because of greater demand. Have you been sort of participating, and how are you viewing in this increase? It's not a new phenomenon. 2024 was very big with regards to all these offerings. This year turning out to be pretty good as well. Any specific situations you've participated or interested in, and your perspective?
Look, good morning, Prashant. So there's been a lot of action, as you rightly pointed out, with a lot of private equity, venture capital, secondary offerings that are coming through, even promoter blocks coming through. And that's kind of putting a lid in terms of the overall market move, given the fact that there has been such large supply. We're talking in aggregate of 50, 60, 70,000 crores happening in a fortnight's time of supply that comes through. What we've been far more, selective in terms of our approach out here. Names that we already own, where we have had a positive view, we do take such liquidity opportunities as an option to top up. In certain cases, which are very interesting, where we have not had much exposure in the past, we are also kind of getting into such names. But we've been very selective as far as the overall block participation is concerned over the course of the last few months or so.
Okay. All right, Harish, good to have you on this morning. So market has been range bound, but it's also been sort of gradually, quietly grinding higher, right? So would you be in the camp that believes that perhaps there's still enough fuel left in the tank? And then, would you be cautious in terms of keeping some money on the sidelines, or would you advise being fully invested? And if so, then where?
So we are reasonably fully invested as a fund house, and we've been having the stance for some time. So it's not something further now. During the phase of January, February, March, when markets did correct, asset allocation products like Balance Advantage Fund, etc., went up very significantly into equities from about 38-40% of net equity. We are now currently at about 75% net equity. But that is, when opportunities did come through, we did increase our allocation. In terms of which are the sectors or which are the areas where we are deploying incrementally to our capital, as far as a fund house is concerned, we continue to view opportunities in private sector banks. We continue to increase allocation into resource plays, be it into cement, metals, materials, chemicals. That's an area where we have deployed reasonably large sums of capital. In terms of pharma, for example, we've increased exposure into the CDMO space, as well as the diagnostic space. That's the other area where we see some opportunities out there. And in the given the fact that the tech stocks have recently corrected in the last 6 months, we've kind of bolstered some of our exposure over there as well. So those would be the broader areas where we've kind of increased our allocation over the course of the last 6 months or so, with a 2-3 year kind of a view outlook as far as these sectors are concerned.
Hi, Harish. Good morning. Good to see you, Ben. I recall the last time we chatted, you sounded very, very bullish, and that was good to hear. Given the kind of, earnings estimates that are coming up, there are some geopolitical tensions as well. You know what Trump is going to do next. Do you still believe that you're as optimistic on the prospects for the Indian markets? And what about that Diwali? By Diwali, you said maybe we'll be singing a different tune, I think so. Do you maintain that by the end of this year, we'll be higher than what we are right now?
My comment was more from an earnings point of view, that we will see a stronger second half compared to the first half. Of course, markets do discount a bit ahead of time, but we do remain positively biased towards equities at this point of time from a 2-3 year point of view. Yes, gains have been very fast and furious in the last 2 months or so. Possibly, currently we are not even discussing anymore what would happen to the tariffs, and, when in July they come through, the 90-day window kind of comes off, how markets are going to react. If deals do get announced, how markets are going to react. So it could be a case of, selling the news at that point of time. So we would see some amount of consolidation and some kind of, correction in the markets possibly in the near term, because a lot of good things have got priced in very quickly. But having said that, continue to believe that earnings in the second half are going to be a lot better than what we've seen in the last 6-12 months, and which is setting up for a very interesting FY27 earnings print as well. So we continue to remain very positive from the earnings construct point of view, and believe that this is a market that needs to be bought on dips rather than sell on rise.
Yeah. I'm slightly pulling back to a macro question, and then we'll get micro again. I remember in one of the conversations, Harish, you'd said that currency risk in Asia, especially with the yuan, etc., perhaps is something that you'd watch out for. If you see today, as someone pointed out to me a while back, China has set its onshore reference rate at 7.1695. It's basic, and it's being, the break of 7.17 is being seen as a bit of a symbolic knee-jerk appreciation. I mean, their stated goal has been more smooth appreciation stance. Is the pressure building up for a one-step appreciation for the yuan? And it wouldn't be so bad, right, from an Indian perspective? I mean, it'd be worse if there is more depreciation. I mean, then you're essentially competing for export market share. But what about this one?
Right. So I think, the construct on currencies, at least from our understanding, has actually kind of changed quite significantly. So earlier, if we were worried, I think our focal point is where the dollar is going to be headed and stabilizing at. What the U.S. administration, and this has been well publicized by Stephen Miran and Scott Bessent as well, that they are looking at a weaker dollar. Now, this is a construct where we've seen the DXY cool off quite substantially, even as they've gone on with tariffs. And therefore, it is important to see where the dollar eventually settles at. That, I think, has got a greater bearing. So a lot of these moves of the yuan in terms of stabilizing, etc., possibly are also a function of where the dollar is going to be at. So I think there's been a change as far as a depreciation concern. For all you know, I think we are possibly headed into another regime as far as instead of a dollar weakness to get into a dollar strength. But of course, these are still very early times. I would think that in the next 3 to 6 months, we will get a better sense as to where the dollar eventually settles at.
You're saying that, no, your view is the risk is dollar goes higher. That's what you're saying? Just to get that right?
So I'm saying that if earlier we had a view that, say, the rupee would go to 89, 90, and 95. And again, I'm not talking about the next 6 months. We're talking about a medium-term slope. At this point of time, there is an equal chance that the rupee can possibly go in towards 80 and maybe even 75. I think this is something which is now a reasonable probability. Earlier, these probabilities may have been very small that actually the rupee may appreciate so sharply. Again, we are not talking about, just to be clear, we're not talking about the next 6 months or the next 12 months. We're talking about a medium-term direction. And I think given what we've seen as far as the dollar is concerned, the probability that the rupee actually appreciates has actually kind of gone up quite meaningfully in the last 3-4 months than what was the case before. So the view is that should the DXY, for example, go closer to 90 or maybe even 85 compared to going to closer to about 110. Again, some macro views, there is never any certainty about any of these happening, but it's a scenario that we would like to kind of pencil in as far as our probabilities are concerned.
Okay, got that. Harish, just one last question on one specific sector from the financial space, insurance. Do you think there are enough sort of triggers lined up for both general and life insurers this year? I mean, in a way, as someone put it, could be perhaps the sleepy hit. I heard those bit of a exaggeration. Sounds like an exaggeration, but sector of the year, as someone called it. What's your sense, Harish?
We would welcome if such a thing happens. It's been a long winter, so to speak, of about 5 years, where insurers have been at the receiving end. There have been multiple flux of regulations that have kind of impeded value creation out there. But purely from a fundamental standpoint, 5 years back, there were many companies who wanted to take an insurance license, be it in general, be it in life. What we've seen in the last 5 years is that the bigger firms have actually become far more bigger in terms of their market shares, in terms of their combined ratios, in terms of their profitability metrics. Possibly there is nobody who wants to start a fresh insurance company or a fresh life or general insurance company, into the sector. Now, this typically sets for a very good case for value creation to emerge over the medium term. So we are positive on the space. We have reasonably large weights and large overweights on the sector. But when exactly they kind of move, possibly there is also likely to be a change in regulator out there. So we don't know what their stance is going to be. But this is something that we think that there is reasonable margin of safety after such a prolonged period of underperformance over the course of the last 3-5 years.
Okay. All right, Harish. Good conversation this morning. Thank you very much for joining in. We look forward to the next one soon enough. Thanks very much. You have a good day. Well, let's now move on to a CNBC-TV18 exclusive conversation. Malnutrition is a bigger problem than obesity in India, says Varun Berry, Executive Vice Chairman, Managing Director and CEO of Britannia Industries. In a conversation with Mangalam, he speaks about the demand trends, the growth outlook as well for the sector. Take a look.
India is a country where, malnutrition is a bigger issue than obesity.
Yes.
Right? When you are at the bottom of the pyramid and you need bhook pyas as the most important thing, right? There's nothing wrong with our products, right?
Yes.
It's basically wheat, oil and sugar, right? Which are all basic nutrients, right? And it's the cheapest form of food. It's cheaper than any other food in the market, right? Now, you are an evolved consumer. You will have a different portfolio to choose from, right? Which will be much healthier. But we have to cater to the base of the pyramid. We cannot say that we will add some additional ingredients in this and we will take this price from, let's say, 10 to 20 rupees. That's going to be a price shock for the consumers, and we can't afford that.
Completely agree with you on that one. And that brings me to the base question of it all.
Yeah.
What does Britannia want to do now?
We want this company to perform consistently. Obviously, there are certain factors which have become more and more important with time. Making our portfolio healthier. I'm not saying healthy, I'm saying healthier. Making sure that we offer, different products to the base of the pyramid, but we bring in the right products for, people who are in SEC A and B. We want our portfolio to be enlarged. So our adjacency business, we are putting a lot of focus on. And I said earlier as well, the first stop is bakery with products which are in the adjacency space, and thereafter we will see where else we want to go. Dairy is a big play for us. We've made very good progress with milkshakes and milk drinks. Not as much progress with cheese. Cheese has been growing, but small single digit. So we want that to move to the next level.
How do you define the next level? Because 2 years ago, I asked you, where do you see the adjacencies business? You said 3 years later it'll be 35%, 5 years later it'll be 40-45%, and 10 years later you'd imagine a scenario where it is 50%. So 2 years hence, it's still at 25%. So 1 year later, will it be 35%?
Well, I hope so. Not 1 year, but maybe 2 years. Maybe we are running behind our schedule. But 2 years later, certainly. But, it should not come at the cost of biscuits.
Yes.
That's the main criteria. Biscuits have to keep growing. This is our bread and butter. This has to grow aggressively, and that needs to grow 2 times this rate of growth.
It's interesting you say biscuits is your bread and butter, but the metric that you're tracking right now in the company, what would that be? Would that be revenue growth? Would that be volume growth? Would that be distribution reach? Or I read an interesting one in your earlier conference call as well. You said volume per outlet, VPO.
See, volume per outlet is very important, right? So we've got 2 clear, things that we measure. One is volume per outlet. Second is covering areas which we haven't covered till now. And there are many small villages which we don't get to directly. So we'll work at both ends.
Could you give us some quantifiable targets for that over the next couple of years?
So our distribution targets, we will, increase our distribution by at least 100,000 outlets every year.
Got it.
On an overall basis, our volume per outlet should remain stable, right? Despite going to much smaller towns and smaller villages, which means that the volume per outlet needs to increase in urban areas. In terms of the SKUs that we sell in urban areas, we sell about 9 SKUs per outlet. Right? Now that needs to go up by at least 10%. So that 9 needs to move to 10, right? Now what would that mean? That would mean that we are selling more categories, more SKUs into each outlet that we go to. So that's how we define our target.
Is margin an outcome of a lot of the things that you're doing? Should we look at it like that? Or are you targeting a margin and then back calculate all the rest?
No, nothing works without targets. So we have a target.
Which is what?
Well,
18 to 19%, what it is right now.
Well, we cannot give any forward-looking statement. We cannot give any forward-looking statement. The target always is to make progress on where you are at. As inflationary times get behind us, we will always be endeavoring to, move forward as far as margins are concerned. But I must say that we are in the top quartile of
your target
food company margins across the world.
There is the counter argument which goes like, India is such a beautiful growth market. Why worry about margins when you can keep increasing the top line? And there are companies, consumer companies, which have, not necessarily food companies, which have 25-30% margins, and they're not growing. So the street believes, what right do you have to have 25-30% margin when you're not investing in growth?
So that's a tightrope walk.
Exactly.
That's a tightrope walk, and you've got to do it really well, because I've seen a lot of companies go wrong there, right? And that's why I was talking to you about inflation, deflation, sine curve, etc. It's a tightrope walk. You've got to make sure that you do not take the consumers for granted. You give them the product at the right price, and also keep an eye on competition and don't go completely out of whack. If you look at some of the companies which have gone wrong on that, you will realize that they just took their eye off the ball. And we do not want that to happen.
So your eye on the ball is maintain margins where they are with some improvement and continue to grow the core. At the same time, adjacencies grow at 2x.
Absolutely.
What does all of that mean in terms of numbers? Again, I ask you that because the last time we spoke, you said if I were to write a 5-year strategy note, of which we're 2 years into already, mid-teens growth would be a possibility. Obviously, a lot happened in the last 2 years for you to not realize that mid-teens growth. But do you think that is a possibility?
It's certainly a possibility. In a country like India, while we have seen a tough period, but once things come back, I think we'll be certainly in that zone, and not just us. A lot of our co-companies in the FMCG space, because that's where the country needs to be, right?
How far are we from that?
Well, I don't think we are very far. I think we are reasonably close to that, and I hope that that becomes the reality very, very soon.
And you can catch excerpts of that conversation all through the day on CNBC-TV18. All right, let's move on now. Time for an exclusive conversation. The shipping sector is facing concerns with respect to growing tensions in West Asia. So how does India stand? I mean, how severely exposed could we be to this? And of course, what is the way forward when it comes to development of waterways in the country, development of ports in the country? Let's talk about this and a lot more. We have with us Mr. T.K. Ramachandran, Secretary, Ministry of Ports, Shipping and Waterways, joining in for Big Picture Perspective. So good morning. Thank you so much for joining in. It's a pleasure to have you on. So we want to start, of course, with the global developments to understand where we are. Now, it's a well-documented fact that 25 to 30% of the world's oil passes through the Strait of Hormuz. And as of now, it's operational. But, sir, what is it that you have been, reading, hearing and preparing for if there is wider disruption? We believe tanker rates have already started moving higher. If the strait is shut down, even for a couple of days or weeks, how can India ensure its energy security? What are the alternatives? I mean, storage. What are we looking at, really?
We have a series of options. Of course, much of this is what the Commerce Secretary or the Petroleum Ministry would look at. As far as shipping is concerned, our role is to ensure availability of vessels. Our role is to ensure availability of containers, ensure that the ports are up and running. And if there are alternative routes, then we explore those alternative routes. Luckily for us, we've had several of these so-called shocks over the last few years, starting with COVID, and then we had the Ukraine crisis, and then we had the Red Sea. So over a period of time, not only has the sector learned to become more resilient, we have also learned to live with the additional costs that might come with having to reroute the ships via the Cape of Good Hope and so on. So I don't think we expect much of a problem because of all this, though there will be some disruptions, also some minor increases in prices, insurance premiums and so on.
Mr. Ramachandran, good morning, sir, and really great to have you on the program with us. Just to take that point which my colleague Surabhi asked forward, I was reading that tanker rates, VLCCs, very large crude carriers from the Gulf to China, pre-conflict they were at about 16,500. They've increased to about $48,000 now. So almost a 3x jump. Now, while a lot of the Iranian oil, bulk of the Iranian oil which goes to Asia goes to China, so that is separate, but we also get about 40% of our oil from that region. Not Iranian oil, but from that region. So obviously there are ships plying from that part to us. Have we also seen a big jump as the industry come to you?
Through that region.
Yeah, through that region. So have we seen a similar kind of jump? Anything you can tell us?
No, there are increase in rates, that much we have seen. And like I said, every time there is a disruption, there is a rerouting, and then there are increases in premium costs available. And because the rerouting happens, the availability of ships, that goes down, availability of containers goes down. So that leads to an increase in cost. And generally the industry has absorbed it. The market has absorbed it. So we haven't found that this has caused disruption in the supply chain. It manages itself somehow. Yeah.
So just one more point. This is something you had alluded to, so again, just going back to it. The rise in insurance costs. And that's already happening. I mean, if I look at some of the international sources, what they're saying is that insurers are now charging apparently 0.2% of the value of the ship. This is just in the last 2 weeks, 7-8 days since the conflict broke out, versus the earlier practice of maybe 0.125% of the value of the vessel in terms of insurance. If costs keep spiking, because there are a lot of these geopolitical conflicts all across, and the Houthi threat, etc. I mean, is the government of India prepared to sort of support industry in any form? Has industry sort of expressed any concern on this? What happens?
At least so far in the shipping sector, we haven't heard from the industry, and they haven't really come forward with any specific demands. So as and when they come up with some specific demand, we will look at them and take appropriate steps as necessary.
Got that. Ms. Ramachandran, all this sort of upheaval around the world throws up, of course, is, as in most sectors, maybe, to reduce dependency, right? Now, in the case of shipping, especially cargo shipping, we rely, I think, almost 90% on foreign vessels. Is the government taking any concrete steps to boost Indian flagged fleet and reduce this dependence?
Yes, so see, there are some short-term measures that we need to take, obviously, which have to then be constrained by the fact of availability of ships. Then there are some medium and long-term measures that can be taken, And of course, you might have heard that in the recent budget that was announced in January of this year, there have been at least 3 measures which have been delineated. One of them has to do with increasing the. All of them basically have to do with increasing the tonnage, Indian tonnage, so that more ships are available, more ships are flagged in India, and more ships are built in India. And you're quite right, almost 90% of our cargo at the moment is carried by foreign flags. Therefore, there is a very urgent need to be able to use Indian flag ships to move our cargo. And therefore, the government's 3 major measures. One was the upgradation of the existing shipbuilding financial assistance policy, so that more ships are built in India. And if they are built in India, they are usually also flagged in India, which means our tonnage increases. The second scheme is for increasing the availability of finance for the industry. As you're aware, the shipping industry was not classified as infrastructure, in the harmonized master list. Now it has been announced in the budget that it will be classified, it will be part of the HML. Therefore, they have access to better tenures, longer tenures, and lower interest rates, which means the industry gains and ships can be built, etc. in India, also owned. More of ownership can happen because you have access to funds which are at lower cost. And the Maritime Development Fund, the creation of this fund which gives equity support to ownership of ships in India, I think again at 25,000 crores is going to be a big boost to the shipping industry's the size of the shipping industry. And I think basically because of the Maritime Development Fund, we expect a lot of investments to flow in. And over the long term, of course, we expect that in the medium term, the ownership of ships will increase. In the long term, building of ships will increase. So these are things that we are expecting. And finally, there is a capability and capacity building pillar, the third announcement that was there in the budget. And in this, we are hoping to increase the capacities of the existing shipyards in the country, as well as open and launch new shipyards, at least 2 to 3 greenfield shipyards, which will have huge capacities, and we will be able to build our own VLCCs and VLGCs, which we are not able to at the moment. So there is a lot of work going on all these areas, and I hope that the next time we have a crisis, we will be, really well prepared.
Yeah. Mr. Ramachandran, just a quick word, sir. How many ships as an industry do we make in India right now? And what's the ambition really? Globally, for example, US is talking about really building up their shipbuilding. I think they've been building a few less than 5 ships a year. China builds hundreds of them every year. It's by far the largest shipbuilder country. Could you give us the Indian context? How many? Where are we now? What's the ambition?
Yeah, so it has been very bad. Of course, we have moved. We were at 0.01 or something like that, and then we moved to 0.04 and now 0.08 million tons GT per annum. So which means we are at less than 1% of the world's shipbuilding output. So that is where we stand. And 3 countries, China at 60+%, Korea and Japan. These are the top 3 countries. Between them, they manufacture or build about 85% of the world's ships, which means we have a lot of catching up to do. Even if we are able to build about 500 or 600,000 GT tonnage over reach that mark, we will be reaching the 5th or 6th position in the world. So the Maritime Amritkal vision, which was launched by the Honorable Prime Minister in 2023, has set a very clear vision for the country in terms of what we want to achieve by 2030 and where we want to be in 2047. So we want to reach the 10th position in the world by 2030 and the 5th position in 2047, which means we are looking at a CAGR of something like 8 to 9% if we just want to retain or slightly go ahead in terms of how much of our cargo we are able to carry. But if we want to carry 20% of our cargo, we have to grow at a CAGR of not less than 17-18%. So this is what we are aiming at, and we hope to be able to touch about 6 or 7 lakh GT per annum. It's about 10 times what we are doing, or 10 or 20 times what we are doing now in the next 5 years. That is how we are looking at it.
Okay, very, very interesting. So that's how the math and the numbers stack up if we are to build Atmanirbharta when it comes to our fleet as well. So that's about ships. I want to also get your view on ports and what's the big picture there, because according to some industry estimates, when there's a broker Motilal Oswal, their estimates say that the Indian port sector should grow at a steady clip of 4 to 7%, so mid-single digits basically over the next several years in terms of how much cargo is being handled, what is the growth like. Do you agree with that assessment? Would you be satisfied with that rate of growth? And then, what happens, because we are in a world where supply chains are shifting dramatically. Trade patterns, trade routes, trade alliances are shifting, rapidly. So how can the Indian port sector ensure that it takes advantage? We, of course, have projects like Vadhavan, and long time, but I think it's 5 years into completion, so it's a while away. But what do the next 2-3 years bring for the Indian port sector?
Like you just mentioned, see, we had a capacity of about 1,600 million tons about 10 years back. Now we are at 2,600 million tons in terms of capacity. We, the major ports, for instance, did about 500 plus tonnage, million tons 10 years back. Now they do about 850. And overall it's about 1,500. So the major ports, which is the government-owned ports, the central government-owned ports, and the non-major, and we don't call them non-major any longer, because some of them are bigger than the so-called small major ports. For instance, Mundra, Pipavav, and so on. So the other than major ports is a term that I'd like to use, and which we now are tending more to use. So the other than major ports actually do about 45%. We do about 55%. So there is a lot of growth, as you can see. It's about 1.7x what was there 10 years back. This growth is attributed entirely to the ports investing in additional capacities, and also to PPPs. Every port, the major port, has gone in for PPPs, and the capacity building is happening in partnership with the private sector also. And like you said, one port, Vadhavan port alone, will double our container handling capacity from 22 million tons per annum to about 45 million tons. So they add about 22-23 million tons. And also, the overall tonnage will be about 300 million. So it will be one of the biggest ports, not just in India, because now we have ports which do 150 million tons or 180 million tons. But one of the biggest ports in the world, which will handle about 300 million tons, will be the Vadhavan port. Then, of course, there is Galathea and so on. So our aim is to ensure that every single state does a master plan for the entire coast which falls within their state, and identifies places where ports can be built or expanded and upgraded, so that we have this master plan ready within the next few months. Therefore, we will be able to concentrate on certain projects which are of critical importance, strategic importance, and by 2047 we want to be at 10,000 million tons per annum, which will be one of the biggest shipping port capacities in the world. 10,000 million tons per annum is what we are expecting to reach in 2047.
Sir, just one question with regards to ports. If you look at the total port capacity, however you want to define it, within operated by the government and operated by the private sector, if you have those numbers ready, and every year, how much of it will you how much will be opened up to the private sector? Because that is the big hope for, we speak with listed port operators as well. Any guidance you can give us?
Yeah, I mean, we have a huge number of private PPP projects happening now. I think at last count it was about 81, and about 54,000 crores worth of PPP projects being either underway or have been completed. I think about 34 or 35 have been completed in the last few years. And our aim is that 60%, at the moment we are handling almost 60% of our cargo through the private operators, which might be news to you. In JNPA, 100% of the cargo is handled by private operators.
Yeah.
So this jump which we have been, and it was only 30% a few years back. So this growth is happening because of the private sector involvement and the PPPs. And as you know, 30 years back, it was the shipping sector, the port sector, which first went in for PPPs, Mumbai and other places. Therefore, the port sector has a lead over many other sectors as far as PPPs are concerned. And it is our conscious attempt to ensure that we have better efficiencies, better ease of doing business, and of course, we bring in investment from the private sector and the speed of execution. So all these advantages we are seeing, and we hope to work on that and build on that.
Very good sort of guidance and sort of insights there. Just one last question. I mean, it's such a vast sector, waterways. And the government, as the Prime Minister said it, I mean, we've heard it from you earlier, we've heard it from the general thrust, right? Developing waterways, which is one of the cheapest modes of transportation, moving goods and people as well. I mean, on a lighter note here in Mumbai, for example, we've been waiting for this Mumbai-Goa connectivity.
Or even within Mumbai, if I could add. I'm glad you brought that up, Prashant. I mean, the ferry service, and I mean, there's so much chatter around it, on, off.
Yeah.
We want to know as Mumbaikars.
It is right there. I mean, the potential is there. And will we see quicker development, sir, on these projects?
Absolutely. In fact, I can go on and on about the waterways and the works that are happening. But just to keep it short, you see, we had 5 waterways 10 years back, national waterways. Now we are at 111, and about 29 of them are operational. This is in Mumbai, this is in Goa, Cochin, Kerala, Orissa, West Bengal, of course, Ganga and Brahmaputra and so on, Orissa. A lot of these waterways need to have water in order to have the ships moving or the vessels moving. So the first attempt has been to ensure that we dredge these fairways, they are called, creating and maintaining fairways. So dredging the national waterways and ensuring there is adequate depth, adequate water, so that the vessels can move, that is our first priority, and which is happening, already happened on the Ganga. We are now able to assure what is called the least assured depth. And it's like a chicken egg. Unless you have the depth ready, you cannot get the vessel moving. And the vessel will not come in unless you have the depth available. And if you have the depth available, you have to wait till the vessel becomes available. So this chicken egg situation is what we are trying to get out of. Then you require terminals which can handle the cargo and also ensure last mile connectivity. Luckily for us, we've built terminals, for instance, on the Ganga, on the Brahmaputra, at several other places. The terminals have been built. So again, then we require vessels to move on these fairways. So again, vessels, we have invested in vessels. We have several vessels being bought as well as deployed on the Ganga, Brahmaputra, for instance. Many private operators have moved them. As you know, the cruise operators, for instance, there are more than a dozen of them moving along the Ganga, and some of the most successful movements are the cruise vessel movements, the river cruise.
Right.
Just for your information, one of the longest cruises in the world, river cruises in the world, the Ganga Vilas, it has moved 3,500 kilometers from Varanasi to Guwahati and Dibrugarh beyond. So this kind of river cruise is booked till 28, and all foreign tourists, cruise tourists. So this is the kind of thing that is possible if you develop this sector. But like I said, infrastructure, vessels, and of course terminals, and ensuring. And we have a scheme for cargo, which is called the Jalwahak scheme, which gives a 35% discount to all cargo, which is more than transits over 300 kilometers or more. And
so very quickly,
we have several projects for transit and all that. Yeah.
Yeah, so very quickly, sorry to cut in because we're out of time. We've hit 10 o'clock. But very quickly, the coastal transportation, transportation of people. Any new plans afoot on that? Whether it is within coastal cities like Mumbai, whether it's Goa. Anything more on people transportation via the coastal routes?
That is the point I was coming to. That finally the integration between coastal and riverine movement. That is very crucial because many vessels which can be used along the coast can also be used on the river in the rivers, and therefore if we integrate, we have seen that there is much more of synergy to be obtained and the movements become more flexible and we are able to generate more efficiencies. So that integration is what we are looking at.
Such a great conversation and so much perspective and insight across your domains. Thank you very much for coming on and patiently taking us through all of that and developing all of this. Of course, such a critical part of the move towards the overall development of the country. Waterways, of course, very, very crucial. Thank you very much once again, sir, for being here on CNBC TV18.
Thank you so much. Thank you so much.
All right, so that's the shipping polls, Waterways sort of entire perspective coming through. 70 points higher, 24,864. By the way, Surbhi, I know what you were looking for specificity. We wanted to hop on a boat and Bandra and get to Worli.
Anything that speeds up movement in the city of Mumbai.
Okay, all right. Nagaraj Sethi is with us with technical trades and what he'd like you to do. He's with HDFC Securities. Nagaraj, morning. 75 points, so it's a much better day compared to the last four. What are your trades?
Hi, good morning, Prashant. Yes, rightly said, showing some signs of recovery from the lower support. There is a support for around 24,700 levels, and the overall market trend has been a choppy. At the higher levels, market is facing a severe resistance at the lower level, showing some supports. So far now, around 24,700 is going to be a support. Once Nifty moves above the hurdle of around 25,000 level, that is going to be an initial sign of strength in the market, and that could propel the market to another 2 to 300 points higher once it moves above this 25,000 levels. At the same time, the range bound action is likely to continue, and if it slips below the support of 24,700 levels and more weakness towards the next support of 24,500 is going to be there for the Nifty for the short term. That is a setup, and in this setup, I have two stocks, as you mentioned, from the mixed side. One is from long and one is from short. And technically, the long is the Indus Tower. Chartically, if you look at the Indus Tower, has been in a consolidation phase. It was in fact outperforming during volatile broader markets, and today it has broken above the range and moved above the important hurdle. Currently trading around 397.98 levels. One can look to buy at this point of time. Initial target would be around 425. One can place a stop loss at 382. And second one is from a short side. Metal sector itself is showing some weakness. And if you look at the Hindustan Copper, that is showing some distribution type of pattern after a decent upside bounces around 265, 270 levels. It has declined in a couple of sessions and it has currently moving below the 200-day EMA. I think overall chart pattern is looking weak. If it comes down, one can look to sell at this point of time, and the target would be around 232, 33 for the initial target, and one can place a stop loss at around 261.
Okay, all right. Interesting trades, and thank you very much for those, Nagaraj. Appreciate it very much. We take a quick commercial break here. Manisha Gupta with commodities on the other side. Stay tuned.
Welcome back. So the equity market continues to have a good Friday morning, still up almost 100 points on the Nifty. Let's now find out what's happening in the world of commodities, where at least in the crude markets, things are still very, very nervous and edgy. Let's go back to Manisha for the latest. Manisha, over to you.
Well, thank you for that. Yes, when you look at the crude oil prices, we've seen 3% of gains in the overnight markets. It's headed for a third weekly gain into there. And then there are supports coming in from the geopolitical premium. And the markets also have seen various statements being coming out. Israel, for one, says that they are intensifying their attacks against Iran. Also, there doesn't seem to be any sign of an exit strategy coming in from either side. That is keeping the crude oil prices in good favor. But the oil rally has hit some breaks in the Asian markets right now. We are trading nearly a percentage point on the lower side. That is after Trump says that he will take a call on striking Iran in 2 weeks from now. So that adds to the uncertainty, and the markets also have gone in a bit of a profit taking in Asia because of that statement that came in last evening. Also, the prices are capped by the fact that you're looking at higher supply expectations for the second half of this year and in 2026 going forward as well. Whether it is about OPEC supplies, non-OPEC supplies, you are looking at that increasing, and that is the reason production elsewhere has offset the disruption impact that the markets believe could come in from the western part of Asia. What the brokerages are saying is quite important, and they have been reiterating, changing, revising their crude outlook in sense of prices going forward. I'll start with Citi, which says that the prices could hit 78 a barrel. We're not too far away from there if the conflict disrupts 1.1 million barrels per day, that is of Iran exports. Iran as of now is exporting 1.1. But Citi also says that disruption of 3 million barrels per day could lead to prices going to $90 a barrel. They still don't believe that the prices can go to a triple digit there. So that is their worst case scenario on the higher side when it comes to crude there. JP Morgan says in an extreme scenario, if there is a closure of Strait of Hormuz, that is the only time that you will see the prices breaking triple digit and going up to 120, even $130 a barrel on the higher side. Goldman Sachs, in the meanwhile, says that the geopolitical premium already into the prices, and $10 of a war premium is what they're looking at. Once this de-escalates, you could be looking at the prices coming down yet again. Interesting report also coming in from Barclays, which says that prices can go all the way to 85 if Iran exports are cut by just about 50%. Remember, Iran is exporting 1.1 million. So half of that also, if it goes down, then the prices can go to 85. Mizuho Group, we spoke to them recently on the channel, and they said that the prices can actually look at a very big range here. $85 a barrel is their bet if there is disruption to the Iranian exports. So there are lots of ifs and buts, and the markets do not seem to be moving unless there is an actual disruption in supplies, in exports as well. But Mizuho also says that de-escalation of tensions can bring the prices down to $65 a barrel in a jiffy as well. Trading.com also has a similar range, 65 to 85, depending on what kind of a scenario do we work with. And Bank of America has actually put a long-term range as well, given the fact that you're looking at higher supplies going forward. Bank of America says that until 2030, they're looking at the prices ranging between $60 to $80. For this year, their average stands at 75 at this point in time.
All right, Manisha, thank you very much for that. So that's oil very much in focus, top of mind really from a financial market perspective. Okay, I think just a quick 30-second check as far as markets are concerned. We're up 90 points at this stage. I think volumes are still lagging, so volumes aren't very high at all, and that's been the case for the last few sessions. And I was saying this earlier, it's just something that I picked up, of course, no confirmation, that big players in the derivative market, like the Janes of the world, the Jump, the Citadels, I mean, their activity has been a little on the lower side the last few trading sessions. There's been a fair bit of attention and focus around it, focus around these players and their role in markets every day and the volatility that we've been seeing. So we'll try and confirm it, but that's just chatter that I picked up. 90 points higher, 24,890 is where we are at. Okay, we'll take a quick commercial break here. It's our special segment. It's the economy. Lata in conversation with Neelkant Mishra of Axis Bank on India's macros and markets. Stay tuned.
Welcome to It's the Economy. India's macros, be it inflation, fiscal deficit or current account deficit, have all been steadily improving. But growth this year is slowing from the post-COVID highs that we saw. And the slowdown is coming at a time when global headwinds are getting a little worse. To size up the economy and equities, I have with me a guest who has a great record of enmeshing macros with markets. My guest is Neelkanth Mishra, Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Neelkanth, good morning. Thank you very much indeed for your time. Let me start with the introduction itself. Like I said, the other macros I'll come to. But where do you size up growth? Do you think the global headwinds can be serious? Some people worry even about domestic urban consumption.
Oh, thank you, Lata. Again, it's always a pleasure being here. On the growth side, I think that growth should improve going forward. And there are several reasons for that. One important reason is that the fiscal headwinds are easing. There is this unfortunate misconception among many that the government was somehow supporting growth in the last 2 years, and it is no longer willing to support growth. It's actually quite the reverse. So the government of India was reducing its fiscal deficit, and it had to, and it was doing the right thing. And this year, the fiscal headwinds are easier. So there was an 80 basis points consolidation. So in FY24 and FY25, fiscal deficits fell by 80 basis points each. This year, the decline is only 40 basis points. So there's still a headwind. Next year, the headwind will be even lower. About 15, 20 basis points. So the drag on growth, so one way of overly simplistic, I know conceptually not 100% rigorous, but still to demonstrate what I'm trying to say, if your potential growth rate is 7% and your fiscal deficit is falling by 80 basis points, you're effectively starting at 6.2. And I think 2 consecutive years of very aggressive fiscal consolidation has shown up in a bit of a drag on growth. But I think this year, the drag is going to be a lot lower, and therefore growth should be better. Okay. On the monetary side, we have seen significant easing. The transmission was turning out to be a lot slower, and therefore this time we have seen the RBI and the Monetary Policy Committee being a lot more decisive in showing their intent, in stating in the statement itself that the economy needs support. And the first signs are clear that some of the rates on new loans are starting to fall. As this transmission picks up pace, because one or few of the banks will break rank and start cutting rates to build business, that will create deposits, that will create the pickup in the momentum, the flywheel starts to move. And the economy, as we maybe say 3-4 months down the line, should start seeing visible signs of recovery. I agree with you that as of now, the high frequency indicators are not looking that good. But if you're doing forward-looking analysis, I think things should be looking much better. Okay. On the global headwinds, I think there is a lot of uncertainty, there is a lot of noise, but I would continue to emphasize that most of the drivers of growth in India are local.
Well, you must be speaking to Amitabh a lot, or to all the bankers at Axis. I spoke to a bunch of them after the policy, more recently actually. And their point is, there is no problem of deposits actually. Paisa hai. And now the CRR cut will come. There'll be a little more of release into the system. Every, incremental deposit also, you have to keep less burden of CRR. Their problem is, dein kisko? They're not very confident that there are so many retail borrowers, for if you do good diligence. So is that a feedback you're getting?
Lata, so, the way you are placing the question or framing the question, you are effectively signaling that monetary policy does not matter. That even if you cut interest rates, nothing is going to happen. And that's something I actually would disagree with. See, like in anything in economics or in anything in life, if you cut price, there will be demand. And because see, so far, February, the rate cuts became totally ineffective because liquidity was too tight. The feedback to the governor was that the CDOIS spreads, which is the cost of liquidity, They fell from 160 basis points to say 100, 110 basis points for a while. And then they got stuck there because some of the banks had been so badly scarred by persistent shortages of liquidity that they were refusing to let go. And so that's normal friction in a undesirable but still expected friction in the banking system. With this clarity that, look, we are cutting by 50 and we are telling you that in the second half, when liquidity tightens, when there is fear that RBI may have to sell dollars and therefore there may be further sucking out of liquidity, rupee liquidity, don't worry, we're giving you visibility, liquidity, we will manage. It is only now that loans, the new loans are seeing lower rates. So the rates on new loans are starting to fall. It is now that the person sitting at the margin who thought that maybe 8.5%, 9% mortgage rates were not good enough at 7.5, 7.8 says, you know what, I can handle this. And some MSME and some promising entrepreneur who was earlier struggling to get access to loans or capital says that, you know what, I think I can work with this kind of interest rates. And it is the first few who then pick on the loans, and then spending picks up, or investment picks up, or whatever, some aggregate demand goes up. And that then gets the flywheel moving. So I'm with you that on current interest rates, the demand, of course, that's where the market is, right? But if you bring down the interest rate by, say, 100 basis points, 150 basis points, there has to be more demand. Or if it is not, which I would disagree with, then we should stop discussing monetary policy.
No, the logic that lower price means more demand is a very fundamental rule in economics. That's how you draw the demand and supply curve. But I can tell you that even in the Reserve Bank, I heard this worry that are there enough good borrowers? It's good borrowers that they worry about. You may have to take a little more risk. But I'll come to that. The point is that, as you say, there has been a tax cut, there has been a rate cut, and that should hopefully engender demand. What's your view on private capex? The discussion so far I've heard is I saw the CMI data, very good, but largely public capex. There hasn't been that much evidence of private capex.
So, Lata, we have been discussing this for quite a while. In my view, private capex is an outcome. It's not an input. See, investors or companies don't invest to do a favor to the economy.
No.
They invest when they see end demand. And the end demand is triggered. So if you think about what is the input, so if private capex is output, then what is the input? Input is real estate. Input is power generation. Because if you think about your own life, my life, what are the goods or services we consume that require a lot of investment, where large materials have to be moved, and they're nothing but residential dwellings, commercial dwellings, transportation, infrastructure, and energy. It'd be hard to find things, and we don't really have semiconductors, but it would be hard to find things which are capital intensive outside of this. So if the real estate cycle is picking up, why do you think cement volume was growing in double digits in the March quarter? Because construction of housing is required.
Has picked up.
And it is going up. Why do you think capex by power producers is starting to pick up? The demand this last 3-6 months have been quite weak, but there is weather, there are several other issues. But I think that there is a lot of new investment needed. And you are seeing that in the order books. And therefore, once these things start to happen, the demand for goods, and you will see that the cement companies are doing capex, the steel companies are doing capex, the power companies are doing capex. So the cycle is turning around. The RARA investments that we saw in the 2009 to 12 phase, I suspect that phase may not come anytime soon, because at that time, the lending environment was very different. Several sectors had been opened up for the first time, and there was massive fiscal juicing that pay commission. So I suspect that won't happen, but there is enough happening right now that
No, that's a fair point. I'm a reporter of that era, and maybe that kind of expectations are there. I take your point on that, which brings me actually to what the Reserve Bank announced on project finance. One of the things that perhaps would have deterred lending loans, project finance provisioning high. Now that's been cut. CRR has been cut. So you think banks are on a very good wicket now? I'm just bringing you down to equities. What are your favorite sectors now then?
The sector remains the same, right? So construction proxy, so we have liked cement, real estate. There are valuation issues with specific names, but by and large, that's a sector that should do better. And of course, financials. So these are sectors which I think should see a turn. You're rightly emphasized the construction provisioning norms being sort of reduced yesterday. And frankly, this is where the earlier norms introduced last year were a bit surprising because, even in policy making, you have to do mapping to where we are in the cycle. If there's no construction happening and you start increasing the construction provisioning or provisioning on construction-related loans, the cycle will never pick up. It is only when construction picks up and you start seeing that, look, the loan book is becoming bigger. This is classic counter-cyclical provisioning. So let the loan book start to build up and you see how the behavior is. And of course, the RBI knows and tracks these things diligently. And if you see risk are building up, then you raise the risk weights. But at this stage, so there are several things that are happening which are going to be supportive. My colleague Jayant published his update on banking yesterday, and he believes that the loan growth should pick up visibly, much better than what several of his peers are forecasting. And we are quite constructive. And in fact, one of the things that we are emphasizing is that the last 2-3 years were about PSUs over private, that the private banks were underperforming the PSU banks. And we think that the reverse should start happening now.
And start now. Oh, okay. That's very important. A very quick one on how do you map the macros to the markets? What kind of earnings growth are you expecting this year? Whatever index you take, either Nifty or any own set of stocks.
So we think that so labor will still not have pricing power, and therefore, if nominal GDP growth is say 10.5–11%, profit growth will be faster. We look at the BSE 200, but I would say a 12–13% kind of growth seems likely. Which means that there will still be cuts. So there will be, I think, cuts to consensus, but they will be much more moderate than over the prior year. And that should be supportive of the market overall. But I'm a lot less worried about the global macro sort of going out of hand now that we have seen the Trump administration sort of respond to market signals that the objective is not to disrupt. So while there are many big changes underway, maybe 25–30% devaluation of the trade-weighted dollar over the next 3–5 years. So see, these are things that what the US administration wants. So there will be big shifts, but those. Yesterday we wrote about how, despite the unsustainable path on which the US debt is, the rise in 10-year bond yields in the US is likely to be gradual and not sudden. And it's because you can keep talking about 20-year forecast, but what the bond market has much more confidence in is the 3 to 5 year forecast. And they're trying to build in a case where somehow the US debt becomes unsustainable is much harder. And therefore it will be a gradual increase, but not a very sudden increase, and which means that disruptive influences on the market may be quite moderate. So I still expect a time correcting market in India. And maybe in a few months' time, as the earnings momentum starts to become clearer, maybe the broader indices can actually start trending up as well.
Okay, thank you very much for enveloping so much into that last answer. Thanks a lot, Neelkant. Always a pleasure having you with us. And I think the market's hearing you. The Nifty Bank is up about 0.8. That, of course, has been the best performer. But super performance coming in from the Nifty and the Sensex itself. Both up almost 1% now. Sensex is up 0.91. So there we are, almost 1% higher. We haven't seen so much green in some time now. So let's celebrate after a break, Chartbusted.